This is an interesting week in the lending game. As you all know, the Bank of Canada increased rates once again by a quarter point, and boy, it's created a lot of havoc. We're also going to talk about how the Canadian rental market is up another record amount in June, and we're going to talk about the MNP Consumer Debt Index that came out just a few days ago. The retail lending rate, which is the prime rate where lines of credits and variable rates are priced off at, breaching 7% and are now at 7.2%, folks. So if you have a home equity line of credit at prime plus a half, you are now looking at 7.7%. Back in March of 2022, it was sitting at 295. Okay, we're up considerably. This is a shit show. So what did the governor say of the Bank of Canada on Wednesday? Basically, CPI inflation is going to hover around the 3% range for a while. He thinks it's very sticky there. That's one of the reasons why he increased the bank rate. He believes the progress to the 2% target inflation rate has stalled. Core inflation has been very stagnant over the while, and it's creating a problem. Guidance suggests the bank will let rates sit at 5% overnight lending rate for quite some time, and he doesn't see inflation hitting 2% until possibly mid-2025, folks. So going back to what I've been saying for a while, we are going to be seeing higher rates for longer. The duration will be long. So we have to prepare for it. We have to start working on finding ways to get through the next year, 2 years, until we could see the light at the end of the tunnel. Okay, because right now, the light is a train and it's coming down the tracks at a fast pace, folks. I always talk about the lag. These interest rate hikes do take some time to filter through. And we're now seeing, as was pointed out in the monetary policy issued yesterday, is that a third of mortgage holders have been directly affected by higher rates, okay? A third. And every quarter that goes by, we'll see more and more people starting to get impacted by these higher rates. I want to go back to some earlier stats I brought out a few weeks ago, maybe even as much as a month ago. As of May, 35% of Canadians have renewed their mortgage into a higher rate, okay? By the end of 2023, that number will increase to 47%. And by the end of 2024, 65% of homeowners will renew into a higher rate. And we're not seeing a point or two. We're talking 3, 4, 5 percentage points higher, depending if you're in the prime or the alternative space. And for those folks sitting in variables, well, they're in for a shit kicking. It's going to be a gong show. So it's really, really interesting to see how this is going to play out. The most exposed folks are the variable static payment holders. OSFI came out with a directive as well this week indicating that banks who have extended amortizations and loan to values in excess of 65% will have to provide more capital to cover for potential losses, because these are higher risk individuals. And that is going to put pressure on banks to start asking these folks to increase their payments, bring their amortization schedule more into line. And it's going to cause a lot of problems. It's going to cause people to hit the brink of cash flow issues. We're already seeing it. We're seeing cars being repossessed. We're seeing credit card delinquencies up. We're seeing car loan delinquencies up. It's going to be a freaking shit show. Get rid of your debt. Your goal should be to get to zero as quickly as possible. And I always use this example. If you could get to half of what you owe before rates double, you're going to pay the same amount of interest. And this is what everybody's goal should be. Unfortunately, these extended amortizations and this very shitty product, the worst designed product in the history of mortgages, the static variable, has put people in positions where they don't care about repayment anymore. All they care about is survival. And, in talking to many people, it's really interesting because, the variable products that we've always recommended, over the years have been the traditional variable product, where when rates go up, your payment goes up. And you get a notice letting you know that the rate's gone up. And it gives those clients an opportunity to reach out to us and ask, what's the next step? What should I do? Should I lock in? Should I increase my payment? What should I do? And we've always worked with people and given them options to make the best decision for them and their families. The problem we have now is that those same folks bump into people that have static payments and they're resentful, believe it or not. They're resentful because I've gotten calls saying, Vince, my mortgage is going up, but my friend's isn't because he's got a static payment and he's still living the high life. And here I am struggling because my payment went up. I said, well, hold on a minute. He now doesn't have 21 years to pay off his mortgage. He's got 63 years to pay off his mortgage, 73 years, 90 years. It's like the Buzz Lightyear mortgage where, the amortization is infinity and beyond. So if your goal is to get rid of your debt, that's not the product to help you. But what people don't realize is they're feeling the crunch when they're in the right product. And, folks have come up to me and says, Vince, I wish I had that product. And I said, well, if you wanted that product, you wouldn't have dealt with me. Okay, I would have sent you somewhere else. And we've done that in the past because people ask for that product and I tell them, I won't sell it. Be aware of what's coming and let's prepare for it. If you need help, you have any clients, if you're a realtor out there watching and you have clients needing assistance, give our office a call. We're happy to help. We're happy to provide some options and solutions for people to think about, digest, and make the best decision for themselves. Let's move on to the next topic because I'm sure you've heard this whole Bank of Canada mess ad nauseum. So I want to move off it. Okay, it's not good news, not fun. But on to Renters.ca, I think, did a survey. The Canadian rental rates for June have gone to a record high. So Canada-wide, the average rent is $2,042 a month, up 7.5% year over year. Okay, record number. And just to give you an idea, a one bedroom is up 10.2%, up to $1,780 a year over year across Canada. Let's look at the two biggest cities to give you an idea of what rents are like in Vancouver and Toronto. In Vancouver, a one bedroom, the average rent for a one bedroom is $2,945, and a two bedroom is $3,863. Absolutely crazy. It's outrageous. Toronto's not as severe, okay? A one bedroom is up to $2,572. A two bedroom is up to $3,300 a buck. $3,300 for a two bedroom, okay? That's average. And that takes into account those under rent control and all that. So just absolutely crazy. So more people are coming into the country. The first quarter had close to 300,000 new entrants into Canada. I think it was 292,000. We're on pace for a 1.2 million person growth in Canada, and the majority land right here in GTA. So expect rents to continue rising because these folks can't afford to buy get a mortgage or buy a house. It's just unaffordable. So very interesting time. I am going to go into the MNP Consumer Debt Index that just came out. How are Canadians really doing? Okay, here's some startling stats for you. Debt regret jumped significantly is the headline. 52% of people surveyed, up 9% over the last time they did this, regret the amount of debt they're taking on in life, a new record. Okay, 48% are concerned about their current level of debt. The cost of living has become unsustainable. Okay, 52% are $200 or less away from not being able to meet their financial obligations at month end. Folks, this is terrible. This is not good. And this is the reason why we're starting to see credit card delinquency, we're starting to see car loan delinquency. There's a follower on Instagram who sent me some data. He runs a car repossession lot. He said there used to be 1 or 2 repossessions a week coming in pre-COVID. He's now getting 8 to 10 a day. a day. Crazy, crazy. I'm not sure if they're Porsches or whatever, but we're going to get to the Porsche tracker in a minute. Household costs are spiraling. 73% are saying that their essentials have increased significantly over a year. And this is just heartbreaking because, folks, people are struggling. People are really, really having a bad time with this. And we got to provide some options and solutions for folks to figure out how to handle this and prepare for it. Okay, how can they go through their budgets and try to find, the wants that they can eliminate and just focus on the needs? How do you start looking at buying in bulk so you could save money? How can you do without? Okay, and those are subscriptions, memberships that you don't use. Really start thinking about maybe taking on a part-time job, seeing if you could clear out that basement, putting in a rental unit, rent out a room. One thing I talked about the other week was the number of international students that are in Canada. We hit a record, okay, in 2022. I think it was 107,000 international students came to Canada. That was up 31% from 2021, okay, and it's only going to grow. Maybe there's an opportunity to rent out a room and make some additional income hosting an international students. Various schools do that. So if you're near one, find out. Maybe you could make an extra $800-900 a month to just give somebody a room and make them breakfast and have dinner with them. So think about these opportunities that exist. Like, these are some good hacks that could help you out over this tough time. My brother-in-law used to did it for quite some time, had 2 students. That's the way he did it, right? Like, it's not a bad thing. Made friends, lifelong acquaintances, and is always keeping in touch with them. And he thought he was ahead of the game by doing it. So think about opportunities like that. Let's go into the used Porsche tracker. As most of you know, since September of last year, I've been tracking the number of used Porsches for sale within a 100-kilometer-mile radius of where I sit. And lo and behold, I started to notice a trend. As rates went up, the number of used Porsches went up as well. And I attribute that to the data point. The data point being, I consider a Porsche not a necessary vehicle. I consider more a hobbyist or a toy. And I believe that as rates go up, people start shedding their toys. They start getting rid of their ATVs, their Sea-Doos, their boats, their cottages, secondary homes. Things start getting liquidated because they need the cash to fight off the cost of borrowing, which is climbing at a ridiculous and rapid pace. So last week, we breached that 1,200 number, sitting at 1,213 last week. We just fell below it. We're down to 1,198 as of this afternoon. So moved down a little bit. I don't know if they've been repossessed or they actually got sold because people were dropping prices on the site. But we're definitely seeing a higher number than we did last September. And we'll continue to monitor that and give you insight on that data point. What's funny is I got a call from an economist and said, Vince, I want to learn more about your Porsche index. I heard about it on a podcast. Somebody referenced it. And I chuckled. I said, Ben, this is Ben Rabideau. Ben, it's just a data point I track off of Auto Trader. And, you just filter through it. You can track it yourself. Like, it's no index. Like, it's nothing that I've tracked and recorded. But I should have. I could have provided some, timely data throughout the seasons and see if there's a pattern. But I didn't track. I didn't record. I just didn't have the time. But I thought that was kind of funny that somebody reached out, especially an economist, for that. Since the Bank of Canada increased, the bond market reacted very interestingly. It dropped. It came back down a little bit. So today we're sitting at 3.73 for the 5-year Canada bond, off of that high that we hit last week. I think last week we were at 392. At earlier in the week, it hit close to 4. So it's come back down, and that is always an indication of what the bond market is anticipating moving forward. It seems like after getting the monetary policy report from the Bank of Canada this week, they have kind of indicated that there may be less likelihood of a further increase. And we'll see what happens on August 15th Okay, August 15th, mark that on your calendar. That's when the July CPI print comes out, and we're going to see how sticky that inflation number is. Okay, remember back in June we hit 3.4, came down quite a bit. Everybody's really happy about that, but still core inflation is stuck in that 3% range. So it's really concerning to the Bank of Canada, and that will give us an indication of what's going to happen in September at the next Bank of Canada meeting. On that note, have a great week, take care, and we'll see you all next week.